Accounts department is probably the heart of any entity. It is what needs to beat to keep the company moving. From an elemental perspective, bookkeeping is the core activity of an accounts department. It is through bookkeeping that everything else branches out. In fact, if bookkeeping does not exist, none of the companies that you see today would exist. So now that brings us to the question, what is bookkeeping? Let us understand. Bookkeeping is a preservation of quantitative records of business transactions systematically. Now, if you look closely, we will see four key words here. First one is preservation, quantitative, business transactions, and systematically. Now, what is preservation? Recording of information for future is what we mean by preservation here, or in other words, you are collecting information and recording it. Now, what is quantitative? We only want to be recording transaction that has a value, a monetary value. Now, what does this mean? Let us understand with an example. Imagine if you are the bookkeeper of a company and you come across two transactions. The first transaction is furniture worth 20,000 has been purchased for the company. And the second transaction that you come across is the CEO of the company delivered a motivating speech to the staff. Which one would you record? Mind you, both of these are business transactions, but only the first scenario will get recorded. And why is that? Because we know exactly the cost of furniture. We know how much we paid for it. Whereas in the second case, we cannot assign a value to the speech that has been delivered by the CEO. Therefore, we do not record it. However, if during the meeting, if meals have been ordered, if refreshments have been provided and arranged for, in that case, we will have to record those transactions because it has a monetary value. And the third element over here is business transaction. From our example, you probably already understood that we would only record business transactions and there is no personal transactions. If something is of the nature of personal transaction, we simply do not record it. Lastly, systematically. Now, what does that mean? When recording business transaction, we need to journalize transaction by following double entry bookkeeping system, which is nothing but a method of recording transaction. If we fail to use the double entry system, we will not be able to generate financial statements. Now, are you thinking, why do we need to generate financial statements? The sole purpose of bookkeeping is to generate financial statements, which is probably the only way your company would be able to communicate to you about its well-being. What you are seeing right now is the overview of the bookkeeping process. As you can see, we start with quantifiable business transactions. That is, transaction that relates to the business and which has a monetary value. Once you have identified what needs to be recorded, we then need to journalize the transactions. Both of this process requires the mind and action of a human being and is not performed by the accounting software. Once the journal entries are appropriately posted by the bookkeeper, the accounting software would create ledgers and trial balance. Only after the trial balance is made, financial statements can be prepared. Now, for your understanding, this is what a journal entry looks like. It reads, machinery account debit to bank account 12,000, which simply means machinery has been purchased for 12,000 through the bank account. This is the double entry bookkeeping system I was talking about. Let's also see what ledgers look like. As we can see, both the accounts have been balanced and closed by the software. Once the ledgers are balanced and closed, the system generates what we call a trial balance. This is an example of a trial balance. Again, the trial balance has been balanced by the system. Once it has been balanced, the system then proceeds to prepare the financial statements, which is basically what we are doing all this for. Now, here's what you need to know. The trial balance and financial statements generated by the software would look perfect even if the data is incorrect. Why is that? Because the software is designed to balance out all the journal entries that is input by the bookkeeper. It is not and cannot be designed to check how logically correct the transactions are. Because of this reason, a bookkeeper must know how to properly journalize business transaction. An error in journal entries causes the financial statements to be incorrect. Now, coming back to the process, once the trial balance is prepared, the system generates income statement, then the balance sheet, and finally the cash flow statement. Are you wondering if the order is important? Technically, yes, because the balance sheet can be completed only after identifying the profit for the year, after which the cash flow statement is prepared. However, when presenting financial statement, it is norm to present balance sheet first, followed by income statement and cash flow statement. This is essentially what bookkeeping is all about. In today's system-driven world, the bookkeeper's role ends with adding appropriate journal entries. If the bookkeeper is also an accountant, he would use the generated financial statements for various purposes.